Welcome to this session with Glenn Surowiec. Glenn recently started his own investment firm, GDS Investments, having previously worked with respected value investor Arne Elsin for more than 10 years, most recently as portfolio manager. To our Manual of Ideas audience, Glenn will already be familiar through his great stock picking skills, for example, highlighting Overstock.com is too cheap to ignore at around $5 in mid-2012. The stock has recently traded around $14. So for those of you who don't know Glenn yet, I would really encourage you to get to know him, and the Best Ideas Conference is certainly a good opportunity to do so. Today, Glenn will share with us his favorite current investment idea, a name that most of you will already know, but with the stock down by about 50% over the past year, it's certainly a good time to revisit and find out Glenn's take on it. So with that, Glenn, please go ahead.
Thanks, Oliver. My idea is JCPenney. Ticker symbol is JCP. It's about a $4.4 billion market cap. 1,100 stores nationwide, roughly $17 billion in sales last year. They'll do obviously a little bit less than that, maybe 14, 15 billion this year. It was founded over a century ago, and I would say the history is filled with periods of success, some long, some less so, followed by periods of failure, which I think is pretty representative of how most companies evolve, especially ones that have been around for over a century. They went through their last major turnaround in 2000. They brought in Alan Questrom. That year, JCPenney lost $700 million, and he was able to put them quickly on a new course by really doing a lot of, sort of low-hanging changes. One was selling the credit card business. They sold the Eckerd drugstore business. They restructured the debt. And I think they really focused their resources on the core department store, and they put a greater emphasis on apparel and fashion and right-sizing the cost structure and becoming more centralized with their purchasing. And the net result of that is that sales per square foot went up about 25% in the first half of the decade. And then in 2004, they brought in Myron Ullman. He had a background with Macy's post-bankruptcy in the early 90s, Louis Vuitton, and JCPenney ran into some very legitimate, I would call them external problems. JCPenney in many ways is a business proxy for Middle America, and Middle America was hit very, very hard between 2007, 2008, 2009. But they also had some internal factors as well. I think in general, the merchandising became tired, the cost structure was bloated, and probably more importantly, the balance sheet was not built for a weak economy. In addition to that, they also had lots of price confusion and unproductive advertising, and just, general merchandising was very cluttered. And just to illustrate some of that, they spent over $1.2 billion in CapEx in 2007, and another $970 million in 2008, just as the economy was on the verge of rolling over. So, they were ill prepared to kind of deal with the problems, the economic problems that we faced in 2008 and 2009. So the net result of the Myron Ullman period is that sales per square foot came down about 18% in the second half of the decade to 2010. So, he might have been the right CEO for JCPenney in 2004, but as we're sitting here today, and certainly when they made the decision in 2011, he certainly wasn't the right CEO for the challenges facing JCPenney then. So enter Ron Johnson. And just to summarize, Ron Johnson, he inherits what I think is just, this poor quality perception, this poor value perception. He inherited a bloated cost structure. SG&A example was over 30% of sales versus a lot of their competitors that were in the low 20s. And I think he really, just in a sort of a structural way, he inherited a company without a real long-term identity. And my interest started when Bill Ackman and Ron Johnson entered the scene in 2011. And I made a note to myself that this has the potential to be one of the better, if not greatest, corporate marriages ever. And I think they both obviously have deep knowledge in their respective industries, yet they sort of had this special advantage, and they overlapped in ways that I think would aid a turnaround, and was mainly their ability to truly think and make decisions with an eye on the long term, which is sort of a really unique it's a really unique advantage to have whenever you're dealing with a turnaround, is to have both investors and management that are really kind of seeing eye to eye about how money should be spent and strategy and things like that. So I didn't buy initially. I put on my radar screen. I tracked it. I listened to conference calls. I read the annual report, and really just did those sorts of things. There was a interview that Ron did in the Harvard Business Review in early 2012, where he really, I think, for one of the first times, he kind of laid out his vision for the company, and he talked about creating value beyond the transaction, and he sounded just not like the traditional retailer. And he talked about what he liked and disliked about JCPenney, and I remember saying that if I wanted to understand retail better, then I think Ron is someone I need to follow. And I sort of do this a lot with other positions. I mean, and I would recommend this more broadly to investors. If you want to learn about a particular industry, find 2 or 3 of the smartest CEOs and track everything they say, conference calls, annual reports. And Commerce Bank was a company I owned for a long period of time, and I certainly did that with Vernon Hill. And I think that certainly Warren Buffett and Prem Watsa are, 2 investors and CEOs to follow the insurance industry. So, I kind of made a note that if I'm either one of 2 things is going to happen. Either I'm going to understand retail better, but I'm going to do it from the sidelines, and I'm not going to own the stock, or I'm going to understand retail better, and I'm going to, if the price is right, I'm going to wind up being an owner. So it was a win-win regardless. And really up until I didn't own it really until a month ago, November, and I decided to take my research to another level, and it was after JCPenney reported Q3 results and the stock sold off, and I really just started taking things apart piece by piece, and I started with management. And I talked a little bit about Ron Johnson, but he, just to round out his resume, he spent 15 years at Target, he spent 10 years at Apple, and a few takeaways from that. I think number one, these are clearly premier emotional brands, and 2 of the finest retailers ever. And number two, in 25 years, he's basically been at 2 companies, so he's not a job hopper, if you will. His commitment actually means something, which I think is outside of founding CEOs, that's a very, very rare quality to have. But it's something that in a turnaround, I think is it's almost required, and it's very, very nice to have. And I think that his commitment was further reinforced by the terms of his warrant purchase. It's not only the amount, but just the way it was structured. It's 7.5-year maturity, and he can't sell or hedge for 6 years. So this is someone who I think just, in terms of having interests that are aligned with shareholders, I can't think of a better structure in place. And I just started looking at the bench, and he certainly brought in people that had experience at Gap and Target and Apple and Disney and places like that, places that are just the who's who of corporate American companies that I respect. So I got very, very comfortable with management, their ability, how they structured things, and whether they were doing things with an eye on the long term. And the next variable I considered is strategy. And I looked at, does it make sense? Can it be financed? And what is the overall execution risk? So let me kind of talk about those things for a little bit. So the 10K mentions the 6 Ps of strategy, and I'll kind of consolidate those into 3 or 4. But the number one is price integrity. Number 2 is establishing these specialty shops with premier brands throughout the store, and I'll kind of circle back with these 2 in a second. The third is something new that's kind of happening at JCPenney beyond those 2, and they're almost becoming this dynamic, learning-centric organization that is more akin to Apple and less associated with century-old retailers. Just a place where I think market knowledge gets quickly redeployed back into the business in ways that increase customer value. So it's it's the analytics of why customers are in the store, and I think a lot of that is they're getting very good at kind of getting that data and then redeploying it back into the business in ways that enhance the customer experience. And the fourth component is just, like I said before, Ron inherited a bloated balance sheet, a bloated cost structure, and I think eliminating waste is something that they've done right away, and he's identified $900 million in savings. $200 million is going to come from efficiency at the home office, layoffs, and things like that. $400 million by changing the in-store process, fewer signage changes, checkout efficiency, and another $300 million will come from advertising expense, lower advertising expense. Obviously, because they're in a less promotional environment, it just reduces the need to spend money on advertising. And just to shine a light on this, from their annual report in 2011, JCPenney hosted 590 sales events, and on average, their customers shopped only 4 times a year. So you can kind of see that disconnect between what they're spending and what they're getting in return. 99% of their promotions didn't work, and now they only host 12 events a year that are a little more consistent with how their customers actually shop. So I told you I was going to circle back with price integrity in the specialty shops. So let me just talk about those 2 real quick. Price integrity. I think what JCPenney's trying to do is make the pricing more transparent and straightforward, which I think ultimately creates greater lasting value as opposed to constantly marking things up and down, or what Ron refers to as creating the illusion of savings, which is kind of how most retailers behave. And I think that if elite companies tend to have very, very clear pricing strategies, and I think that Ron experienced that at Apple, but certainly Costco, Walmart, I think that there's no illusion of savings. I think that there's everyday pricing, there's pricing that makes sense, and there's pricing that ultimately creates it's pricing that not only creates value for the company, but it's the right thing to do by customers, and I think that their brands generally prefer a less promotional retailer. So I think it's value that's created throughout the supply chain. And I would just, as a comment, on the surface, this is very bold, and bold ideas are usually met with skepticism. And I think that, certainly I think Apple's decision to get into retail, that was met with skepticism. A lot of things that Whole Foods was doing was met with skepticism. I remember a lot of things in Amazon in 2002 that they were doing was met with skepticism. And if you believe in something, if you have conviction, I think that, you know, a lot of times ideas are met with skepticism, not because not on merit, not because the ideas are lousy, but I just think because they don't conform to industry norms. So let's talk about the specialty shops, because I do think that this is a big component of how value is going to get created over time. So to me, it's common sense that you would want to position brands differently from a merchandising perspective. Again, I think it's what consumers ultimately want, and I think it's how the brands themselves would want to be represented in the stores. And so JCPenney rolled out these specialty shops, and I think it's important to remember they rolled them out. The first phase started on August 1st, 2012. So we're talking about 4 months ago. And really, let me just I can kind of walk you through the growth curve just to kind of show how early on we are in this process, but how important that initial data is, because November of 2012, they'll have 10 shops, which represents 11% of the total square footage, and these are their private brands: Sephora, Levi's, Izod, Liz Claiborne. And in a year from now, so November of 2013, they're going to roll it out. They're going to have 40 different shops, which is going to represent 40% of the square footage. And they're going to add brands like Martha Stewart and Disney and Joe Fresh and Carter's and Dockers, all really high-quality brands that have relevance in the marketplace. And by 2014, they'll have 70 shops, and by 2015, they'll have 100 shops. So we're at 10 today, and in 4 years, 3 years, they'll have 100 shops. That's sort of the growth curve that we're expecting. And I think I think the first question that I asked was, is it working? Do we have evidence one way or another, quantitatively or qualitatively? And I think the answer is, clearly yes. The JCPenney specialty stores do almost $270 in sales per square foot. And old JCPenney does $134 in sales per square foot. And I think it's important to think about that just for a second, because at this point, the risk is not with the new strategy. It's, can we roll this out fast enough? And that's not always the case in a lot of turnarounds. I think that investors are not taking on capital misallocation risk. And so from a strategy perspective, I think we've kind of moved on that sort of trial maybe stage into, yes, this clearly works. And I think what's left is, they obviously need to continue to execute a model that's proven. And I think there's a liquidity case that needs to be made. So the next question I ask myself is, can they finance it? And I think if you listen to the presentations, I think that they're very sensitive to doing this at a measured pace in a way that allows them to finance things internally. They think to retrofit the stores over the next 3 years, because again, it's not adding on new square footage, it's converting existing square footage. So the cost is actually relatively low, but it's about $1 billion over the next 3 years. They have $1 billion in cash that's their expectation for the end of the current quarter, and they have a $1.5 billion untapped line of credit. So you have $2.5 billion of liquidity that is there to meet, $1 billion in capex in order to retrofit the existing square footage. And I think because the reinvestment opportunity is proven, I think to the extent they need a little bit of money, I think that they will access the capital markets accordingly, because again, it's not as though they're using it to survive. They're using it to basically reinvest in a model that we know works. And I think from a qualitative perspective, I think certainly the customer's perception has changed from, tired or old-fashioned and cluttered, disorganized, to something that now is perceived as being modern, trendy, organized, and really just delivering more value to the consumers. And next, I moved on to, so this is sort of how I think about valuation. So today, again, there's about 220 million shares outstanding. The stock's at $20. You're looking at a market cap of $4.4 billion on a company that does, at the bottom here, $15 billion in sales. I would say those are artificially low because they're working through some. 2012 is a transition year, so I would say that more normalized, you're looking at closer to $17 billion in sales, which is what they did last year. But I think of valuation as almost a range of different outcomes with certain certainty that, certainly I don't think Bill Ackman and Ron Johnson are locked into a certain strategy. I think both will ultimately do what's financially responsible, and that is, maximize the asset base, whether that's the operations or the real estate, whatever it is. At the end of the day, they're going to pursue the path that generates the most shareholder value. Management thinks that $200 is very doable in terms of sales per square foot. I use that as my base case. And we're in 2012, but I'm thinking about this more in the context of 2015 and 2016. I do think that $200 is very doable based on several factors. One, the initial performance of the specialty shops and the growth curve associated with these shops, and also based on what I would consider average competitors. I mean, Kohl's, Macy's, they're all in close to $200 in sales per square foot. There's lots of apparel specialty retailers that are north of $300. Gap, American Eagle, and I kind of use that as my starting spot, and I just sort of walk down the income statement. $200 in sales per square foot translates into $22.5 billion in sales. And I think management is guiding toward 40% gross margins. From there, I come up with $9 billion in gross margins. $9 billion in gross margins. The long-term goal for margins, gross margins, are 40%. Operating expenses, they think they can get down below 30% of sales. That's SG&A plus D&A. It's mid-30s today. This is very, very much in line with how their competitors are and where JCPenney has been historically. They think 13% for operating margins is, where they want to be mid-cycle. I'm not modeling that much, but I do think that this is a business that at maturity can do somewhere between 2.2, 2.5 in EBIT, which is about $10 or $11 per share. And then you back out, interest expense is running $55 million per quarter, which is $220 million per year. That's about $1 per share. So after tax, I come up with somewhere between $6.50 and $7 per share in after-tax profit on a stock that's $20 right now. And, I think, again, I think about a range of outcomes. So I think I might be high with some metrics, but I might be light on some others. I think if they really, really execute at the level that I think $200 might be low in terms of sales per square foot. But they might be, they might ultimately be high and margins might be lower. But I think at some point we're looking at mid-cycle earnings per share at $6, and I think that happens sometime over the next 3 or 4 years. And I think there's a strong argument to be made that as the model matures and changes are fully implemented, that a second and third layer of value could emerge in the second half of the decade. And you know, if the store within the store concept really sticks, there's a lot of apparel specialty stores that are generating sales that are, you know, at least 50% higher than $200 per square foot. JCPenney is also very underrepresented in major markets versus Kohl's and Macy's. So I think there's opportunity to open new stores. I think Ron Johnson said 75 in his last conference call per year. And I also think that this is a company that has assets beyond their operations. I mean, 49% of their square footage is owned, the real estate, and the rest is leased below market in the $4 per square foot range. So I do think that if you see a recovery in real estate, I think there's the right leadership involved that you know, they would potentially, if the market doesn't give them the right value, I think that there's opportunities to unlock value through, you know, other means with the real estate. Those are my prepared remarks. If you have questions, I'm happy to answer any questions or talk about anything else.
Glenn, thank you so much for these thoughtful remarks on JCPenney. I'd like to refer everyone who has questions for Glenn to our online Q&A area where you can ask questions, or you can also contact us or Glenn directly, who I'm sure will be happy to answer your questions. Glenn, if I may, I have a few questions myself. I'm wondering if you could talk a little bit more about this plan that management laid out. Is it to 2015? And where do you see the biggest risk then to this plan as management has laid it out?
Well, I think it's a good question. So just let's go back to that growth curve that I talked about. Again, so as we're sitting here today, I think, you know, phase one was rolled out in August 1st, 2012. You're looking at 10 shops. You're looking at 11% of the square footage. And at maturity, which is 3 years from now, November of 2015, you're looking at 100 shops. And I guess I'm not sure that certainly there's execution risk, but I would say that is mitigated by the fact that this is not, this was a plan that was thought through at a very, very detailed level. This is something that makes sense. This is something that's working both qualitatively and quantitatively. So the risk is really, you know, can they roll it out fast enough, right? I mean, at the end of the day, you can only retrofit so many stores and do it so quickly because there's funding issues. And I think that management has been very, very careful that they want to be able to fund this using internal cash generation and or, you know, that $1.5 billion facility they have. I'm not sure there's that huge risk. I mean, I think in most turnarounds, there's a big, big question mark around the underlying strategy. I think what you have here, you have a special set of circumstances where you really have management that's locked in. You have a second layer of management that is absolutely committed to what's happening, and you have a concept that has moved beyond that question mark stage. This is not a maybe anymore. This is something that works. This is something that customers like. This is something that suppliers like. And this is something that makes sense mathematically. It makes sense in every way. And I think that the only risk I see is that if you look at 2012, they, I think, probably took on too much initial change, and I think that, you know, as a result, it probably created some customer confusion. And I think because of that, traffic is down because there's fewer promotions and fewer coupons, and they're basically moving away from that really promotional environment that used to drive traffic. With that said, conversion is decent, so the people that are going in there actually like what they see, and so they need to fix that. And again, go back to my earlier point, which says when I said that what's interesting to me beyond some of these changes is that this is becoming a learning-centric organization. This is not a static organization. This is an organization that's learning constantly and is really taking data real time and it's redeploying it back into the business. So I that is they're sort of moving beyond that. And Ron, and he'll be the first one to tell you that they probably did too much in the first couple months, and I think they saddled the consumer with too many changes, but they're in the process of fixing that. So I don't see this huge risk out there. I really don't. I see what I see is a model that works. I see a model that has been tested, and I think it's a matter of just, if they can execute at X, they need to be able to execute at 2X and then 5X and 10X, and it's almost like building up the infrastructure in order to be able to do that. And I think that's really where their emphasis is right now.
What do you think is the end game then in terms of the real estate strategy versus this operating turnaround strategy?
Yeah, okay. So I would say that I don't know if there is a real estate strategy that's been rolled out publicly. What I would say is that it's there. This is an asset-rich company. And I think when you combine that with the fact that you have these shareholder-oriented stewards of those assets, both on the board and management, I just think that bodes well for shareholders. I think one way or another, I don't think this has to be this huge real estate play in order for it to work out. I'm just pointing out that if you look at if their real estate, they have 112 million in square footage, and 64 of that is going to be dedicated to specialty store model, and that really puts them at number 2 in the real estate business behind Simon. And Simon's the largest mall REIT. They have 88 million in square footage, and their market cap is significantly more than JCPenney. I think what I sort of think of is, I think Ron's a smart guy, and I think Bill Ackman's a smart guy, and I think that they're going to optimize assets, and they're going to create value one way or another. If the market doesn't give them the value that they deserve, that shareholders deserve, then I don't see them sitting on their hands and not doing anything about it. I think that they will use resources, and I think they'll adjust accordingly.
Can you give us a sense of where do you see value of the real estate portfolio, or has Bill Ackman talked about the real estate value more recently?
I would argue that if you put JCPenney next to some of the big, and I don't necessarily want to put a number out there, but I do think that if you put it in a chart, and if you look at Simon, if you look at JCPenney, and if you look at General Growth, you have publicly traded comps, and you have a company like Simon that has roughly 2.25 mall locations. Their mall their specialty store square footage is about 88 million square foot, and they have an enterprise value of over $70 billion. JCPenney's enterprise value is $6 billion and change. Just to put things in context, I mean, you have a General Growth that has 135 mall locations with 132 million square feet, and they have specialty store square footage of 61 million, and their enterprise value is $35 billion. So I mean, I think again, when I think of second and third layers of value, I'm not banking on that, and I'm not including that as part of my base thesis. I think that the upside, without any big formal real estate play, is 2.5 times the current quote. What I'm saying is that as we get in mid-decade, and I think that these specialty stores become desirable, and they mature, and sales per square footage goes up, 50, 60, 75%, maybe even 100%. I do think that you have a board that is wired to maximize the value of that real estate one way or another. And I think that if you separate all the different assets, then I think you're talking about upside that's probably somewhere between 5 and 7 times the current quote.
So would it be fair to say then, if the operating turnaround succeeds, you would see value north of $70 per share, and I guess by 2015, and on the other hand, if the turnaround doesn't go according to plan, the real estate supports a value that's probably even higher than where we are today in terms of the share price. Is that fair?
I think that's fair. Yeah, I think that's fair. I mean, again, like I don't. These assets are not joined at the hip, and I do think that I would rather. To me, there's more protection in a real estate turnaround that is asset rich behind the scenes, and real estate's real estate, and the market seems to recognize the value inherent in some mall retailers, Simon, General Growth, Tobin, but they seem to ignore it when that real estate is owned by the retailer themselves. So I'm saying if there's the option to carve out certain assets, I don't think that this is lost on the board. I think that they will make decisions that create the most value one way or another. And if you just get back to ingredients for a successful turnaround, I think that management is everything. I really do. I mean, if you have a core business that's relevant and it can be fixed with proper execution, then you need a management team that's structured the right way. And I really believe that with Ron and Bill, I think that this has the potential to just be just a phenomenal corporate marriage, because I think they both have very, very deep knowledge. Certainly Bill was involved in the General Growth reorg. Ron has a very rich retail background, and really when you come down to it, those are really where the assets are. That's where the value is tied up in JCPenney. They have real estate assets, and they have a business in 1,100 locations. And I think I'm not banking on both of those going. They don't need to really, really go perfectly in order for the stock to be up 3- or 4-fold. But I'm saying that can't be ruled out given the leadership behind both of those assets.
And in this context, you seem to have done a lot of work also on the history and Ron Johnson's, for example, previous experience and turnaround success at Target. How do you contrast the task here at JCPenney versus what happened at Target, or what, for example, another great investor is doing, Eddie Lampert at Sears? Have you looked at those, and what gives you the confidence that JCPenney is the one that really is the most interesting for you as an investor?
Well, when I studied the strategy, I came back and I said, does the strategy make sense? And I think I wasn't sure a year ago, and we didn't really have any data. And I think when on one level, I mean, certainly, what Ron said made sense. I read what his interview in the Harvard Business Review in early 2012, where he kind of laid out his vision, but everything was unproven. I mean, at the end of the day, I mean, you talk about greater price transparency and just being less gimmicky when it comes to how you price certain products, and just really pushing the value closer to the customer. And he talked about creating value just kind of beyond the transaction. And you know, on the surface at that time, I mean, it all sounded great. I guess what changed really was last quarter. We now had some data to sort of back it up, and at the same time, we had data that suggested that this not only works, but it works really, really well. And price had come down because I think the market was becoming more and more short-sighted, and perhaps they were, you know, they couldn't see around the corner, and they couldn't kind of get past the messy third quarter. I don't, but you just had this dynamic in play where I think that we were, as owners, we were getting additional clarity around the strategy, yet the price was coming down. So I from a margin of safety standpoint, I thought that this security went up a great deal over the last month or two. In terms of how Target is kind of, certainly I would say what interested me with Ron's background in Target is that Target has always been 2 or 3 steps ahead of the competition. And I just think if you want to understand how to connect with consumers, and you want to understand how to create enduring value as a retailer and not be so promotional and really focus on merchandising and just maybe being bold and being a little different, I think there's a handful of retailers that you want to study, and I think that Target is in that small group. And the fact that Ron was there for 15 years, certainly Target has a very, very deep bench. There's a lot of talent there, but Ron was certainly very instrumental in that growth curve. And I think that at a minimum, you walk away knowing what a great retailer looks like. And I think that the fact that Steve Jobs, who I think that is just universally respected, he could have probably picked anyone to come in to lead Apple's retail effort, and he picked Ron Johnson. And that's good enough for me. And you also had mentioned Sears as well. I think Sears is a little different. I think that Sears, I think what Eddie is doing, I think there's similarities in that they're both going after the cost side of the equation. I think there's similarities in that both have this unique ability to think long term. And I think that is unbelievably healthy and unbelievably rare in turnaround. So the fact that ESL owns 60% and I think Fairhome owns another 15 or 20%, Sears can really make decisions in ways that benefit the company, 3, 4, 5, 6 years. So I think in the case of Sears, there's a lot of things that are working, but they're working beneath the surface. And I think that Sears has become, it's hard to restructure the stores that need to be restructured because of their size. But I think that Eddie I certainly think he's guided by mathematics, and I think that Ron and Bill are also guided by mathematics, and I think that Eddie will pursue the path that is financially responsible, and I think that JCPenney is going to pursue the path that's financially responsible. I do think that their underlying strategies are different. I think their underlying competitive advantages are different. JCPenney has a couple of private label brands, but Sears is different. Sears is, the Craftsman and the Die Hard and the Kenmore, Land's End and things like that. And, I think Sears' strategy is really kind of geared toward maximizing the value of those brands and really kind of protecting those brands in the marketplace. And I think what JCPenney is trying to do is really just saying, all right, we have, phenomenal square footage. We have, we're in every major market, and what we see is a supply chain that's slightly dysfunctional. We have, this huge just level of waste that occurs at the store level with advertising and just clearing through merchandise, and it's being done in a way that I think hurts sort of the fabric with the relationship with the customer. And I think Ron's like, this is just not how great retailers behave. Great retailers basically put the customer at the center of everything they do, and they develop a strategy that serves those customers. I think that those are the similarities and differences. But I think ultimately, I think the outcome for both of those are probably more correlated than people think. I think that at the end of the day, I think both of them will succeed.
Now, when it comes to judging you mentioned the last quarter, how that gave you some more confidence about the success of the strategy. What are some of the key metrics then for you to judge the continuing progress of the operational turnaround at JCPenney? What metrics do you really look to?
Okay, so obviously they have to stabilize old JCP. And I mean, I think what they need to do is continue to sort of promote this less promotional environment and really execute at the store level, convert. And so I look for stabilization in old JCP, and I look at continued success in new JCPenney. And eventually they're going to be able to outrun the problems in the old model. I mean, at 11%, right now, this new format is only in 11% of the square footage. They only have 10 shops. But just think about how different that store is going to look next year with 40 shops and 40% of the square footage in 1 year. And, they're going to roll out the whole street strategy and how different that look is going to be. And then you have, instead of just Liz and Izod and Levi's, you add in Martha Stewart and Disney and Carter's and all these others. And then you do that again the following year. You can see how all of this great momentum builds rather quickly. So I guess what I'm looking at specifically, I want to see that new JCP is still, store by store, specialty store by store, brand by brand, that square footage has indeed been put to a higher use. And the evidence is overwhelming. I mean, it's when they convert to the new format, that square footage does phenomenally better. So I just want to make sure that the road that started on August 1st, 2012, that we're going to continue to go down that same road, quarter after quarter after quarter after quarter. That's what I'm looking for.
Now, when you look at the share price then, and it's certainly down quite a bit over the last year, how do you even attempt to interpret that or reconcile it with what you're seeing operationally? Is it just a matter of too high expectations in 2011 and going into 2012, or where do you see some evidence that may even concern you, that not all is positive, and that perhaps there is a reason why their share price has come down again, and there's some more risks than or other risks that perhaps you weren't aware of when you first looked at the strategy and got excited about management?
I would say that my experience is that the market, and I think there's a lot of factors that drive this. I think one of just is that it's extraordinarily short-term focused, that it doesn't properly discount these transformational growth stories. And if you go back and if you look at Apple or Amazon or Costco or even Whole Foods, the initial analysis is often wrong and or short-sighted. And when Apple went into retail, if you actually read the analyst reports, back in 2000, Apple would say over and over and over that, here's why we're doing it, here's why it makes sense, and they were immediately compared to Gateway and Gateway's failed retail strategy. And I just find that interesting because you had, here's this company that was, you had 30 analysts that were following it, yet there was it was met with skepticism and disbelief. I mean, Apple would say our retail strategy is about A, B, and C, and the market would come back and say, well, Gateway tried this, it doesn't really work. But they would say, well, we're not Gateway, and they would, try to highlight the differences, and the market would say, well, geez, it just, you can't go from hardware or software, and you can't, you don't really want to get into retail, it doesn't make sense. And so they spent a year just overcoming the fact that they weren't Gateway. And believe it or not, I think that kind of describes that initial growth leg. I mean, I think people need to remember we're less than a couple months into this in some ways and less than a year in other ways. I mean, this is still very, very new. And I don't think the market digests turnarounds, especially when there's this degree of change, properly. Again, I mean, they missed it with Amazon. Amazon, they're not profitable. They don't make any money. They don't do this. And Amazon's like, well, if you read Jeff Bezos in 2001 and 2002, there was a very clear explanation as to why they were doing certain things. And obviously, they could have been profitable. It's just they chose to, really redeploy all of their free cash back into the business in ways that basically, just raised the customer experience. They were investing for the long term. And so I actually wrote down a couple quotes from Apple. They're moving to retail. And so Ron has been this before. There was one quote, they'll shut down and write off huge losses in 2 years. That was in 2001. It's completely flawed. It reminds me of Gateway. Whole Foods, same kind of thing. When you walk in these big, beautiful stores, it's hard for a consumer to think that this is a value-oriented type of retailer. Amazon, 2002. So far, they have not shown that sales of other merchandise can grow rapidly and be profitable. So I guess the fact that there's a lot of initial worry and skepticism, it almost kind of validates my confidence.
So typical contrarian idea then, and a great buying opportunity as the market does not appreciate the changes that are happening on the ground.
And I absolutely, and I would just argue that if you really trace the source from where all this criticism is coming from, it's generally by people that haven't really earned the right to criticize, if that makes any sense. They haven't really built anything themselves. They just, it's easier to criticize than it is to just really accept something for what it is initially. It's just the way it is. It's human nature. I don't really know what drives people to do, but I mean, at the end of the day, you have a guy, Ron Johnson, who spent 25 years of his life at two of the greatest companies in the last half century. And then you have, a guy, Bill Ackman, who I think is, certainly one of the best investors in our generation. And again, there's everything's still being met with skepticism. And, listen, frankly, the same people that are skeptical of this strategy, they were skeptical of Warren Buffett in 1999 because he wasn't investing in technology stocks, and they were skeptical of Amazon in 2002, and they were skeptical of Apple's retail strategy in 2001. Bold ideas are, no one really embraces them in that first leg. They don't. But let's check back in 2014.
Well, we certainly will do, and even before that, I'd be just curious to understand a bit more about your general approach and how JCPenney perhaps exemplifies your general approach to picking stocks. Can you tell us a bit more about that?
Sure. I would say it's about 1/4 stock picking and 3/4 sort of what I call intelligent stock owning. And I mean, I think the stock picking is very straightforward. My goal is to certainly find mispriced investments, and this is kind of where I want to be at the conclusion of the process. And there's a sort of a very orderly process that I follow. I mean, I develop ideal lists, probably similar to you and lots of other investors. I review Value Line weekly. I review the Value Line supplementary reports. I look for just misunderstood situations, spinoffs, restructurings, and I really just try to be organized and take note of everything I read and just be, just on alert, if you will. And I think that the internet is great in a lot of ways because it's certainly easy to access lots of information, but I would also say you have to be careful about what you access. I think there's a lot of cluttered, poorly researched might be, but I think there's a lot, just because of blogs and other things that are sloshing around in the system, I think it's easy to find information that is perhaps not the best research stuff. So I try to avoid blogs and things like that. I mean, there are a handful of sites I go to because I know the contributors are high quality. But in general, I like to go to the SEC filings, things that are not as tainted. And I like to go to company presentations. I like to listen to conference calls. I don't read many analyst reports. I don't go on blogs and things like that. So, and I think from there, I like to really dive into the quality of the industry, the competitive position, who are the leaders, and I want to look at market share within that leadership category. Is someone number one today, but were they number 4 3 years ago? I just want to make sure. I'd rather invest in an industry that's very slow moving in terms of market share change. And certainly financial metrics, balance sheet. I want to understand management. I want to understand, really study how they allocate capital. Are they realistic about growth? Redeploying that capital, things like that. And really, I mean, the last piece of that is just really making sure that the valuation component makes sense. I mean, I could get everything right, and if I fail that valuation test, if I'm buying something that's just simply not cheap, I can't overcome that mistake. And then really, what I think is just something that is just not often talked about, and I really think it's at the center of strong long-term results, is this what I call intelligent stock owning. And I think that too many times investors process the same information differently pre and post purchase. And it was Ben Graham that was famous for saying that individuals that cannot master their emotions are ill-suited to profit from the investment process. And I really go out of my way to just make sure that the process I have in place and how I think about information is the same before and after I buy a stock. And if you have conviction in what you're buying, really you'll be able to double down on your own ideas when when the stakes are the highest. So to me, I think it's about really after you buy something, when you lose 20% or you lose 30%, and every headline says that what you're doing is a mistake, and you have clients that are putting pressure on you, how do you behave at that moment, and how you behave at that moment really is the driver of your long-term rate of return. It really is. And a lot of people see the brilliance in Buffett, Munger, and Berkowitz, and they kind of see it rooted in, maybe the ideas that they come up with and their stock picking and things like that. And I don't want to just put that aside, because I do think that's important, but I really believe that what makes them great is their ability to see reality through data and facts and not headlines and noise. And to do that when the stakes are the highest and there's just lots of emotion in the market, I think that's special. That's special. And I think that if you look at business schools and how they're structured, they're very, very good at teaching people the stock picking side of it. There's lots of emphasis on valuation and discounted cash flow, and looking at the Porter model, and looking at the competitive dynamics within an industry, and all those different things. And lots of people get that process right, and then they own it, and 6 months later they sell it, or the stock goes down 25%, and they're incapable of really making that hard decision. And I think that's sort of, having that high emotional IQ is sort of what separates, really, really average investors and the great ones.
I really like this concept that you've introduced here, and just to bring it back to J.C. Penney, I guess it's really a stock that one needs to own, and perhaps the market with the trading mentality gives us this opportunity to own this at such an attractive price as you described it. I guess related to that, I'm curious then, what would cause you then to perhaps sell J.C. Penney?
So I would say that I want to see the old J.C. Penney square footage. I want to see it stabilized. So, I would look at a deceleration or an improvement in same-store sales. I would want to see a continuation of what was started in August, and that is you're taking poorly configured square footage and you're putting that to a higher use, and brands are coming in, and I think there's a very, very clear vision of the company that at the end of the day, if you bring in certain brands, and if you merchandise those correctly, and if you give them the appropriate square footage, the initial evidence is that you're going to increase your sales per square foot. So again, I would want to see, as we get into that next leg of growth, that next leg resembles the first leg, and then the leg after that resembles. So yeah, I want to see some cumulative effect of the change in strategy, and I think what you'll see is a slow improvement as we get into next year, and then certainly by 2014, where you have 70% of the square footage that's been retrofitted, I think you'll see continued improvement. And that I'm looking not necessarily for linear improvement, but I'm definitely looking for directionally improvement in sales per square footage and those types of metrics. And I certainly will have an eye on the balance sheet, and at the balance sheet, again, there's this tug of war between the ability to finance the new JCP and how quickly those results will hit the bottom line. And so one has to sort of outrun the other. I mean, at the end of the day, they have to be able to finance this and see results before their ability dries up. And so you have to constantly compare what you're seeing on the income statement with how the balance sheet is reacting. You want to make sure that one is financing the other.
Now, you worked with Arne Elfin for many, many years, and just curious, lastly, if you could tell us a bit about your experience at Elfin Capital, and perhaps what motivated you to start your own firm, and what the focus is at your firm that may be a bit different from Allison Capital.
Sure, that's a great question. Well, let me just, I'll sort of I'll walk through my background just a little bit, and I'll spend a little bit more time on my time at Allison Capital Management. I mean, so my background, I worked as a commercial credit analyst in Commerce Bank, which is now TD Bank, in their real estate department before graduate school. And then I worked as a derivatives structuring manager for Enron right after. And in 2001, I went to the equity side and joined Allison Capital Management, as you've noted. And I sort of went down that equity research analyst and portfolio manager path. I started managing my own client portfolios in late 2008 and have been fortunate to put up very, very solid returns. And I think just for my own development, and I think kind of where Arnie was with his firm, this is kind of the natural next step, was for me to start my own firm. In a way, it's sort of indicative of, Arnie's ability to train me and bring me to this point, if you will. I mean, at the end of the day, it really, I think, is credit to him and kind of, our relationship over the last 10 years that I've actually gotten to the point where I can go out on my own. And so I've done that by opening up my own firm, GDS Investments, and that was done last month. I mean, Arnie, I think that initially there was, I think what I learned from him is certainly you have to be adaptive as an investor. I think that, in 2000 and 2001, the opportunity set and the market environment was dramatically different than what it is today or what it was 3 years ago or 6 or 7 years ago. And I think that you constantly have to be mindful of where the areas, where the pockets of opportunity are. And in 2000, you had really the major indices were massively overvalued. Tech, telco, and certainly the GEs and the who's who of the S&P 500. Lots of overvaluation there, but then you had this extreme undervaluation in a lot of small and mid-cap stocks. And so, I mean, I think Arnie, if you look at his picks, and I know they're on his website, a lot of his early top 10 picks, I mean, I think JCPenney was one of those back when Alan Questrom came in, and Office Depot and companies like that went up, 100, 200% within 18 months. And I think initially, I mean, I learned from him, sort of the ingredients for a successful turnaround. I think certainly, at the center, you wanted a core business that was worth restructuring. Management was very, very important. New leadership obviously could come in and maybe see things that old leadership, and it would certainly, build a winning culture a lot faster than old management could. And I think, Arnie's background and, certainly as an accountant, I think analytically he was able to look at the balance sheet and really just, provide a healthy level of realism with any turnaround and, really decipher which turnarounds were financeable and which others were, it doesn't really matter how great the idea is, liquidity is going to dry up in 12 months, and really try to stay away from those situations. And I think Arnie has also adapted, his methodology. I think that, I think today he puts, a huge emphasis on the quality component than he did before. So I think, in 2000 and 2001, there was a lot of those sort of Ben Graham cigar butts, and they did very, very, very well. But I think that, the economy and I think certain industries and just sort of, technology and things like that, I think has placed a greater emphasis on business quality and perhaps ways that it didn't before. I mean, certainly, Apple and Amazon have put huge pressure on lots of different industries over the last 10 years, and those risks and pressures weren't really alive in 2000 and 2001. So really, to his credit, I think he's a better, different investor than he was 10 years ago. And I think that he sees how industries have changed, and some have gotten stronger, some have evaporated. I mean, if you look at, Blockbuster, Kodak, and companies like that, or even, old tech, whether it's Microsoft or Hewlett-Packard or Dell, there's been this huge change in leadership, and we sort of entered the decade really, thinking highly of, Microsoft and Dell and, HP and some of those companies, and they've sort of been left behind, and now it's, there's sort of this new leadership, and it's Amazon, and it's Apple, and it's Google. So I really think that investing money today, in some ways, I think you have to be really open-minded. You can't be static. You have to really, just really place an emphasis on business quality, and really emphasize market leaders. And I think he's been instrumental in sort of shaping that as I look at companies. And I would say there's a lot of similarities. There are differences. I think that I think that I will probably I'm probably more geared toward spin-offs, restructurings, mid-cap companies, smaller cap companies. Just maybe companies that are a little less researched.
Great. Well, Glenn, we're going to leave it at that. Thank you very much for your comments and your presentation, and certainly the idea that you presented today, J.C. Penney. We look forward to continuing the dialogue.